You wake up, brush your teeth, wash your hair, and wipe the counter. Those ordinary minutes actively fund one of the world's largest multinational empires. Procter & Gamble has spent 180 years securing a hold on things you cannot live without. Their entire business model rests on absolute necessities, tracing back to simple bars of ivory soap. Because they sell essential goods, they generate a stabilized revenue stream that weathers severe economic shocks. When crises hit, panic buying drains grocery shelves, cementing P&G's cash flow while other industries stall. By prioritizing items that are consumed and replaced daily, the company locks in a massive, recurring revenue cycle, fueled by necessity rather than discretionary spending. That dominance started with a century-long head start. Decades ago, P&G aggressively built out an extensive physical manufacturing infrastructure that still underpins their operations today. Today, those factory floors are heavily automated. High-efficiency equipment processes raw materials into finished goods at speeds that drastically lower the production cost of every individual bottle and box. Building that kind of massive supply chain requires an astronomical upfront capital investment. For a new company trying to enter the consumer goods market, the cost of constructing competing factories acts as a lethal deterrent. This expansive network of physical assets makes it nearly impossible for any new brand to reach the same unit cost efficiency, effectively pricing out competitors before they can even launch. We can map this leverage using the 5 Forces business framework, which analyzes how a corporation asserts dominance over its environment. P&G sits directly in the center, pushing immense outward pressure onto the raw material suppliers they rely on. The math is entirely in their favor. Because P&G purchases ingredients in astronomical global volumes, suppliers lose their bargaining power and must accept the price points P&G dictates to secure those massive contracts. This bar chart illustrates the resulting shelf space dominance. P&G applies its massive purchasing power at the retail level, supplying such a wide variety of multi-brand items at low prices that smaller competitors are physically crowded out of the supermarket aisle. To maintain this leverage, the company actively sheds non-essential weight. In 2013, they evaluated their portfolio and divested their DuPont food additives business entirely, refocusing their capital strictly on their most profitable product lines. Market monopolies require deliberate engineering. P&G starves out competitors for shelf space while systematically dictating financial terms to the suppliers feeding their factories. To manage these global variables, the company looks past traditional balance sheets. They use the Harvard Analytical Framework to integrate their financial reports with strategic and prospective analysis, identifying market shifts before they appear in the ledger. We see this applied in their calculated external partnerships. P&G collaborates with the U.S. Environmental Protection Agency to advance circular economies and works with the Nigerian government to provide clean community water sources, fulfilling consumer expectations for sustainability while securing their operational environment. They take that deep understanding of consumer behavior and translate it into unique marketing. Rather than listing dry product specifications, their campaigns rely heavily on psychological association. Take their advertising for Head & Shoulders. Instead of focusing strictly on the clinical treatment of dandruff, they broadcast commercials featuring the fluid, effortless movements of a fencer to psychologically imply the smoothness of the athlete's hair. True scale demands 2 distinct assets: raw manufacturing muscle and deep psychological integration into the global socioeconomic environment. However, the massive size that protects the company creates a dangerous rigidity. Long-established management structures move slowly, making it difficult for P&G to pivot when market demands suddenly shift. This inflexibility leads to visible friction in their operations. Internal reviews have highlighted delayed response times and unprofessional problem resolution in their online after-sales support, weaknesses that directly erode the customer loyalty they've spent decades building. While P&G moves slowly, highly agile direct-to-consumer startups are aggressively leveraging social media. These smaller companies quickly capture the attention of younger demographics, steadily chipping away at P&G's massive market share. In a fast-paced digital economy, historical legacy and physical scale cannot completely defend against rapid innovation. To offset domestic vulnerabilities, P&G targets emerging global markets. By expanding their operations in regions like China, they leverage local government tax incentives designed to encourage foreign investment, directly boosting their profitability. These overseas regions house a rapidly rising middle class. This demographic shift provides a massive, reliable consumer base eager for essential daily products. Internally, P&G is forcing a technological upgrade to speed up their decision-making. They are integrating big data analytics, artificial intelligence, and the Internet of Things to optimize their sprawling supply chains and anticipate consumer needs before they happen. To survive its next century, Procter & Gamble faces a distinct corporate contradiction. It must maintain the global infrastructure of an entrenched monopoly while fighting with the relentless agility of a startup.